Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money games that corporations play, and believe me, this latest report from CNP Incorporated is quite the puzzle box. This filing is an amendment to their quarterly report, meaning they had to go back and fix something or add something they missed the first time around. And when you look at these numbers, you might just see why they needed a second shot at telling their story. First up, let us peek at the big picture for CenterPoint Energy Incorporated. For the 3 months ending in September 2025, their net income, which is essentially their profit after all expenses, jumped to $293 million. That is a nice jump from the $193 million they made in the same period last year. Now, for the 9-month period ending in September 2025, their profit was $788 million, which is up from $771 million in 24. So on the surface, things look like they are moving in the right direction. When we look at their balance sheet as of the 30th of September 2025, their total assets were $45 billion. That is a lot of zeros, and it is up from nearly $44 billion at the end of 2024. It looks like they have been investing in their business, adding to their property, plant, and equipment, which increased by about $2.5 billion in 9 months. That usually means they are building or upgrading infrastructure, which is a good sign for a utility company. However, their debt also went up. Their total long-term debt net of everything was almost $19.4 billion by the end of September 2025. That is a significant amount of money they owe. Now let us turn the spotlight to CenterPoint Energy Houston Electric LLC. Their net income for the 3 months ending the 30th of September 2025 was $231 million, an increase from $179 million the previous year. For the 9-month period, their profit was $456 million, down slightly from $465 million in 2024. So while they are profitable, things are a little tighter here. Their total assets stand at over $21 billion as of the 30th of September 2025, which is up from nearly $20 billion at the end of 2024. They too have been investing quite a bit, with capital expenditures alone costing nearly $2 billion in 9 months. But again, debt is a key factor here. Their long-term debt net increased to over $9.2 billion. Just like the parent company, they are carrying a good chunk of debt. And finally, let us look at CenterPoint Energy Resources Corp. Their net income for the 3 months ending the 30th of September 2025 was $74 million, more than double the $34 million from the same period last year. For the 9-month period, they brought in $465 million, a good increase from $345 million in 2024. This subsidiary seems to be performing quite well. Their total assets are just under $15.5 billion. Interestingly, their capital expenditures were over $1 billion for 9 months, but their investing activities as a whole show a net cash provided by investing activities of $36 million. This is because they had proceeds from divestiture of over $1.2 billion, so they sold off some assets. Looking at their debt, it is down to just over $4.4 billion from $5.1 billion, so they have been actively paying down debt, which is a positive sign. Let us dig a bit deeper into CenterPoint Energy Incorporated's revenue. For the 9 months ending September 2025, total revenues were $6.85 billion, up from $6.38 billion in 2024. The electric segment brought in $3.62 billion, while the natural gas segment brought in $3.22 billion. Utilities revenues make up the vast majority of their income, and they saw an increase here. Now for the cash flow, which is super important for understanding how a company is really doing. For the 9 months ending September 2025, CenterPoint Energy Incorporated generated almost $1.7 billion in cash from its operations. That is a strong number and an improvement from the $1.25 billion generated in the same period last year. This indicates that their core business is bringing in more cash, which is always a good thing. However, their investing activities used up over $2.6 billion. This is mostly due to capital expenditures, which were almost $3.4 billion. They are definitely investing heavily in their future. Their financing activities provided over $900 million. This included bringing in a lot of new debt, almost $2.85 billion, while paying down about $1.07 billion. Looking at profit by segment for CenterPoint Energy Incorporated, their electric segment saw a nice boost. Net income in the electric segment was $293 million for the 3 months ending September 2025, up from $226 million in 2024. The natural gas segment also showed improvement going from $30 million profit in 2024 to $71 million in 2025 for the same 3-month period. For Houston Electric specifically, total revenues were $1.13 billion for the 3 months ending September 2025, up from about $1.05 billion in 2024. Their net income also saw a healthy jump from $179 million to $231 million. Expenses did go up though, particularly operation and maintenance expenses, which increased by $58 million, primarily due to storm hardening expenses after Hurricane Beryl. For CERC Incorporated, the natural gas segment showed strong revenue growth. For the 9 months ending September 2025, revenues were over $3.1 billion, a good jump from $2.79 billion in 2024. Their net income also saw a significant increase reflecting this revenue growth. A big item impacting the natural gas segment for CenterPoint Energy Incorporated for the 9 months ending September 2025 was a loss on sale of $43 million, which is related to the divestiture of their Louisiana and Mississippi natural gas businesses. Now let us talk about commitments and contingencies. This is where companies disclose potential future obligations or risks they are exposed to. They have significant purchase obligations for natural gas and electric supply, with billions of dollars committed over the next several years. For example, CenterPoint Energy Incorporated and CERC Incorporated have natural gas supply commitments totaling over $4.3 billion and $1.3 billion respectively for CenterPoint Energy's electric supply. These are long-term commitments that will impact their cash flow for years to come. And then there are the legal matters. Hurricane Beryl has led to multiple lawsuits, including putative class actions with claims of negligence and gross negligence, seeking damages potentially exceeding $100 million. They are also still dealing with lawsuits from the 20th of February 21 Winter Street Orm event. With hundreds of defendants and significant alleged damages, the company is vigorously defending itself, but the outcomes and potential financial impact remain uncertain. It seems like they are facing a storm of legal battles on multiple fronts. On a more positive note, there were some leadership changes. On the 8th of October 2025, Jason P. Wells became the chair of the board and Christopher H. Franklin was appointed lead director. These moves often signal a shift in strategy or a focus on governance. And speaking of strategy, CenterPoint Energy Incorporated announced a new 10-year capital plan to invest a massive $65 billion from 2026 through 2035. This is a big commitment showing they are planning for significant growth and infrastructure development. They have also been busy issuing debt. In October 2025, CenterPoint Energy Incorporated issued $700 million of junior subordinated notes. This is a way to raise capital, but it also adds to their already substantial debt load. Overall, CenterPoint Energy Incorporated's financial performance shows growth, especially in their electric and natural gas segments. Their reported net income is up nicely year over year. However, you have to look closely. Their balance sheet shows over $22 billion in long-term debt and lease obligations for CenterPoint Energy Incorporated alone. While they are investing heavily in infrastructure, which is expected for a utility, and have a large capital plan, managing this debt is crucial. The various legal battles and potential storm restoration costs could also put a strain on their finances in the future. Their credit ratings are currently mixed, with some stable and others with a negative outlook. A downgrade could increase their borrowing costs and make it harder to raise capital. For example, if their credit ratings were to drop one notch, their borrowing costs on the revolving credit facilities would have been insignificant, but a further drop could really hurt. In conclusion, CenterPoint Energy Incorporated seems to be in a growth phase, investing heavily in its infrastructure and seeing positive results in its core utility operations. However, the significant debt levels, mounting legal challenges, and uncertainty surrounding future regulations and infrastructure costs are considerable risks to watch. They are balancing growth with significant financial and legal hurdles. What do you think about CenterPoint Energy Incorporated's strategy and their financial health? Let us know in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more corporate financial insights. And of course, join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we will see you in the next episode.